Hello and welcome to Between the Lines. The podcast brings you deep insights into the evolving reinsurance landscape from across Asia Pacific. I'm Mithun Varkey, Editor-in-Chief, and we're recording here in the Hong Kong newsroom of InsuranceAsia News. Join us as we unpack the week's biggest headlines and bring you a preview of the stories shaping the market ahead. We have a special guest on this episode, a change in perspective. We usually hear from underwriters and brokers, but today we are bringing in the insurance buyer's voice. Tim Huxley, Chairman and CEO of Mandarin Shipping in Hong Kong, joins us. He's led Wak Wong Maritime as CEO, served as Managing Director of shipbroker Clarksons Asia, and is a member director of P&I Club North Standard. Tim joins us to unpack how the risk landscape for shipping is shifting amid escalating tensions, not just in the Strait of Hormuz and the Red Sea, but also renewed volatility in the Black Sea, how that is reshaping shipping and the global economy.
If you're willing to trade to those areas, you are going to have to put up with heightened cost of insurance cover for some considerable time to come.
Joining me in this episode is Deputy Editor Andrew Mullen, reporters Joana, Nguyen, Roshan, Nambiar, and our intern Aleyna Wang. Welcome, everyone.
Hi, everyone. Thanks a lot, Mithun.
Right, let's get started. So one of the biggest yet underreported stories of the past couple of weeks has been the back-to-back weather events that has affected mainland China. We had Typhoon Maisak hit southern China, thunderstorms in central China, and Typhoon Bavi, which made landfall twice in China and led to significant losses across the country. Aleyna, you've been following the developments from China. Can you tell us about the events and the impact they've had?
Okay, so as we can see, the Chinese insurers are facing a surge in claims after Typhoon Bavi battered the country's east coast. So state media said insurers have received nearly 380,000 claims tied to Typhoon Maisak and Bavi, with estimated losses of $943 million. Bavi made landfall in Zhejiang over the last weekend, bringing heavy rain, strong winds, and widespread evacuations. The storm has already triggered tens of thousands of claims, with Ping'an, P&C, and China Taiping among the major insurers reporting significant losses. Extreme weather continues to affect China. On Sunday, torrential rainfall in Shanghai's Yangpu district overwhelmed the drainage system, inundating local roads. Local weather authorities expect heavy rains to continue into this week.
Thank you, Aleyna, for that update. We did see the videos from Shanghai. The flooding seems pretty bad for a city like Shanghai, and it's likely that the losses from the events will continue to rise and could be a major loss event for insurers, which is quite interesting considering for the first half, insurers have had fairly benign losses. Joana, you've been writing about the loss experience of insurers from the region recently, as well as the impact of weather events, including El Nino. What can you tell us?
Right. So I think what Aleyna just shared about NatCat in China is very important because according to a report by Gallagher on, NatCat losses in the first 6 months of the year, loss activity in Asia was dominated mainly by the flooding in China, which so far has brought about $6 billion in economic losses. And in terms of insured losses, the Victoria bushfires in Australia was the costliest event, resulting in around 430 million insured losses. So Asia in total recorded less than 2 billion in insured losses in the first half of 2026, the lowest in H1 continental total since 2017. And this is compared to 46 billion insured losses globally recorded in the first half of the year. So you can see that these losses can be quite benign compared to the history, with no single insured catastrophe loss exceeding 10 billion. However, the report cautioned that El Nino is coming and is expected to be one of the strongest El Nino's events on record, and it will reach its peak by the end of 2026. So El Nino often leads to, reduced hurricane activity in the Atlantic basin. And this could, set the stage for another series of soft reinsurance renewals in the future. However, this could also lead to more typhoons in the Pacific. So we can expect more rains in South Korea, in Japan, Eastern China, and also other regions like India or Vietnam could see drier and warmer conditions. So that could lead to, significant economic losses as well. Insured losses, maybe not, but due to the low penetration level in Asia, but then it will lead to lots of impact on the economic side. So that's something that the industry have to be mindful of as well.
Thanks, Joana. I think, yes, the sort of impact that El Nino will have will remains to be seen, especially in Asia, given that, there's two separate different kinds of impact in North Asia, Southeast Asia, and Australia as well, which will be very dry as well. In other big news, it was a pretty busy week for deal makers. Again, we've seen quite a few deals. There's a lot of news coming from Australia. Andrew, you've been looking at the Steadfast deal. What's the latest on that acquisition?
Yeah, so this latest piece of news had us scurrying around early morning last week. This news that KKR has joined the investment consortium seeking to acquire Steadfast Group, the Australian insurance broker. This is the deal valued at $5.4 billion. KKR will serve as the core lead investment partner with Dragoneer in Steadfast retail brokerage business, while Nguyen is acquiring the underwriting agency business. The terms of the bid, which were announced in June, and the timeline were unaffected by this change. Nguyen and Dragoneer also confirmed that KKR's involvement is not a condition to the completion of the transaction.
Thanks, Andrew. That's certainly a big development for that particular deal because, it's the biggest insurance broker around in our region, and, a marquee private equity investor like KKR jumping into the fray makes it more exciting. There is a soft lock-in, soft exclusivity for these bidders, but it's likely that after the end of the soft exclusivity, which ends next month, we could see more bidders joining the deal. So it'll be an interesting deal to follow. We also seen Sompo do an acquisition announced late last night. In fact, Roshan, can you tell us about Sompo's latest acquisition?
Yeah, so in the second cross-border deal in less than a month, Sompo International Holdings has formalized an agreement to acquire Brazilian insurer Fator Seguradora. Fator Seguradora focuses on corporate insurance and business risk management solutions with particular strength in property, surety, and financial lines. Sompo's Brazil CEO said that the transaction is fully aligned with the sustainable growth strategy of Sompo and their ambition to expand their relevance in technical segments with higher added value. Fator's Seguradora has a strong and recognized presence in the lines that I mentioned earlier, and which also are some of the segments that Sompo sees as potential growth.
Right, this is the second deal by Sompo this month, right? They announced the acquisition of U.S. workers' compensation specialist service insurance companies earlier this month. And this certainly is like a specialist insurer as well. Sompo had exited its retail business in Brazil a few years ago. So they're really building out their commercial and specialty expertise in that market. The other interesting M&A deal we've had recently was Marsh's expansion in Thailand. Andrew, you were the first to report on that development. Can you fill us in?
Yeah, so when I first saw this on LinkedIn, I wasn't sure if Thailand CEO Derek Heng had let the cat out of the bag a little bit early because this was the only place this deal was mentioned. We did have it confirmed through our sources that a press release was coming, confirming this deal, and that came last week. That confirmed that global broker Marsh had confirmed that its Thailand subsidiary, Marsh PB, had become a wholly owned part of Marsh, and this was from July the 1st, and would now operate under the legal entity name Marsh Rish Thailand. The broker had bought out all its local shareholders, including PB Group and other minority investors. And in the statement, Marsh said the move supported its growth ambition in one of Southeast Asia's most dynamic markets.
Thanks, Andrew. I'd just like to bring Roshan back in, and this is about Thailand again. Big risk loss in Thailand recently. A fire in a bar in Bangkok. What can you tell us about that and what the loss is looking like?
Yeah, so Dipai Insurance has been identified as the insurer for the Bangkok bar at the center of the deadly fire blaze that occurred just over a week ago, which at the time of this recording has seen the death toll rise to at least 35 people. Thailand's insurance regulator, the OIC, says that the venue held a fire policy worth 40 million baht or $1.2 million US, covering building renovations, furniture, fixed installations, electrical, and stock. While the cause of the fire is still under investigation, early reports suggest that it may have started with an electrical short circuit near the stage. Local authorities say that damage assessments are still ongoing, and they are also checking into whether the deceased and the injured have personal accident, health, or life cover.
Thanks, Roshan. There's quite a few risk losses from Thailand in the recent days. Moving on, finally, Joana, you had a great piece on the low altitude economy in China and how insurers are facilitating the sector. Can you walk us through your story?
Right. So normally when we think of drones, we think of, a type of camera that can capture aerial landscapes or cinematic shots. But in some countries, especially China, drones are being used for many other purposes, such as delivery of goods and passengers, rescues and surveys. So this is part of a concept called low altitude economy, which refers to, flying activities by manned or unmanned aircraft vehicles within airspace up to 1,000 meters above ground levels. So while drones are a prominent part of the low altitude economy, there's also something called electric takeoff and landing aircraft, or eVTOL vehicles. They are often described as flying taxis, so they can fly like a helicopter, but because they are powered by electric batteries, so they are quieter and produce, zero emissions. So obviously, China is leading the global development of the low altitude economy, both in scale and speed. Other than that, we also have Middle East as well. It is also supporting the growth of this type of segment with several well-funded projects. So I spoke to a casualty underwriter from Macau to understand, the risk profile of low altitude economy applications and how insurers and reinsurers are navigating this segment. So the risk profile of low altitude economy mostly resembles that of general aviation, with most immediate and widely recognized exposures related to personal injury, property damage on the ground because of mechanical failures, battery depletion, or software malfunctions. We also have more catastrophic scenarios, for example, collisions with buildings, power lines, or commercial airliners. And also technology and cyber-related risks are also very critical because, drones are highly reliant on software-driven autonomy or AI or bandwidth connections. And in terms of coverage, low-altitude economies are being addressed mostly through modifications to existing policies rather than creation of, entirely new products. Standalone drone policies are available, but insurers tend to prefer, extending commercial general liability policies to cover property inspection, site surveys, and other, simple drone operations through endorsements. But for eVTOL insurance, because this is fairly new, so the market is developing more slowly than drones, because passenger exposures, certification, and airworthiness frameworks, operator licensing, airspace regulations is still evolving and it's quite stricter than drones. So that's why insurers and reinsurers are more selective and cautious with eVTOLs, and it has limited loss data or operational data for modeling. So that's why it's still incomplete for eVTOL. And similarly, from pricing perspective, commercial drone insurance are stable. However, for eVTOL, it's highly customized and more costly. So that's what I have learned so far from the market underwriter. So there's more to this story, and I encourage our listeners to check this story out because there's many insightful information that you can find from this.
Thanks, Joanna. It was a fantastic story. I mean, we've spoken about drones and flying taxis for a long time. This seemed like something from science fiction, but we're certainly seeing that come true. I mean, I think just last month was that PCIC insured the first eVTOL for operations in Hong Kong. So it is actually happening, and this could be a very interesting market for insurers in the coming years. Great. That's all the stories from the past couple of weeks. Looking ahead, what do we have on the plate? I'll start with Roshan. What are you working on?
So as a follow-up to my story regarding El Nino and agriculture, which I spoke about previously, I thought it would be interesting to do one regarding El Nino-related drought and its effect on the energy sector in APAC, as it's home to some of the world's largest hydropower producers like China, India, and some of the Southeast Asian countries. From my agriculture story, one of my sources said that losses typically fall outside traditional property damage and business interruption policies because typically there's no physical damage to insured assets, yet due to the electricity generation dropping. So just like my agriculture story, I plan to reach out to numerous power and energy sources to see how the strengthening El Nino will continue to affect the sector.
Yeah, thanks, Roshan. Your story on El Nino and its impact on agriculture sector, which is on our website, is certainly worth a read. And we'll look forward to your story on the other impacts of El Nino. Joana, what do you have coming?
So there has been an uptick in the number of IPO deals in Hong Kong in recent months. And normally we would think that more IPOs would mean more demand for financialized insurance. However, I've been speaking to the market and they told me that most of those companies doing IPO in Hong Kong were incorporated in China and they are required to buy insurance from Chinese insurance companies. So it actually don't add much value for direct insurers in Hong Kong. And the industry is actually trying to advocate that through the insurance association here, because companies are using Hong Kong lawyers, using Hong Kong accountants, but they are not using Hong Kong insurers. So that would be a story that I'll be working on and talking to sources in Hong Kong to see their views on this.
All right, Joanna, thank you very much. In other stories that we're working on, I mean, we have a story on the cyber market, which is apparently at a sort of crossroads with prices nearly bottoming out. And also we'd have a story on the cannabis market in Asia coming in the next few days. So keep an eye out for those exciting stories. That's it from all of us today. It's been a great conversation. Thank you, everyone. Let's get back to work.
Thanks a lot, Mithun.
In this episode, we're joined by Tim Huxley, Chairman and CEO of Mandarin Shipping. Tim, who's a shipping industry veteran, will give us the risk owner's perspective on the escalating tensions in the Middle East and Black Sea. He unpacks the challenges for the sector, how risk considerations are evolving, and what that means for the future of the shipping sector. He also commends the insurance industry for its pragmatic and supportive approach to a sector facing unprecedented volatility. Listen in. Hello, Tim. Welcome to Between the Lines. We typically have underwriters, brokers, climate modelers, and the likes on the show, but it's great to have you join us this week to bring in an insurance buyer's perspective, especially at a time like this. I mean, it's a pretty difficult moment for shipping. As we know, we've seen a maritime disruption peak with escalations not just in the Strait of Hormuz, hearing of reports of blockade in the Red Sea, but as well as renewed activity in the Black Sea with Russia and Ukraine stepping things up. So there is a lot to talk about. There's a lot to unpack. Just to start, how has the sort of latest escalation in the Middle East, including Red Sea, as well as Black Sea, changed the way shippers and ship owners think about operational risks? What are you seeing on the ground that isn't exactly reflected in the headlines?
Well, thanks, Mithun. It's great to be with you. The operational risk has obviously increased considerably. And as you say, it's not just the Straits of Hormuz, it's also the Red Sea, and the Black Sea is seeing a lot of activity there with these respective conflicts that are going on. From an operational risk point of view, I mean, you've now got 700 oil tankers off the Middle East, and the reluctance of owners to actually go into those areas is very strong. I mean, you don't really want to be risking, first and foremost, your crew or your ships. So you've seen a massive slowdown in the amount of ships that are making it through the Straits of Hormuz. I mean, on Monday, apparently there were only 4 ships that went through. So this is obviously being massively disruptive to global trade when normally you have about 120 ships going through. So there's a huge disruption there. And from an operational point of view, I mean, this is insurance we're talking about. It's all about risk management. And frankly, right now, an increasing number of ship owners are just not willing to take that risk. So even though insurance rates have gone up considerably, and you can still get insurance cover, it's not that the risk is uninsurable. And the insurance industry is doing a great job in assessing the risk. And there are some ship owners that do still think it's worthwhile, but an awful lot now are holding back. And what you're seeing is that of those 700 oil tankers that are off the Middle East, and I'm sure you'll see this in the coming few days, quite a few of them will begin to weigh anchor and ballast round the Cape into the Atlantic, which means you'll have a build-up of tonnage there, which might well affect the market. So it's going to be a very intriguing few days, and I think that overall the situation now, I would say, is probably worse than it has been since the start of this conflict. There are more ships getting attacked.
Just a couple of weeks ago, we were thinking we're coming to a resolution and there's probably, the proverbial light at the end of the tunnel. But things have worsened. And as you sort of mentioned, Strait of Hormuz is still blocked. There is Red Sea. We're hearing about blockages around the Houthis getting more active in that area, and Black Sea. We haven't had these three come together at the same time. Is there an aggregation of risk around for shippers? How do you see that sort of playing out in the coming days? And how does that immediately impact shippers?
It's certainly now the focal point of most conversations within the shipping community. We're not so much worried about markets and what you're earning on the ships. If you're willing to run the risk of going into these areas, you can actually make a lot of money. But it is now all about trying to risk manage your crew and your assets. And I think let's just look at the Red Sea for a moment. This is sort of where it's escalated. The Houthis have come back. That was a real problem really last year before the Strait of Hormuz blew up. And this is going to cause really quite big problems to global trade, because it's all about going around the south coast of Yemen. And in addition to the Houthi attacks, what you've also got is an escalation in that age-old problem of Somali piracy. And we had another ship taken by pirates and sailed to Puntland in the last few days. So the amount of risk that is there that ship owners are having to evaluate, I haven't seen it at such a high level for many years. Now, with the Red Sea, what has happened is that Saudi Arabia is effectively being blockaded now. And what was happening was that in order for Saudi to export crude oil, which they weren't able to get out through the Straits of Hormuz, it was being sent by pipeline to Yanbu in the Red Sea, and then exported from there in the pipeline to the major market, which was the Far East. Now then, with this escalation in Houthi activity there, and the risk of attacks in the Red Sea increasing quite considerably, what ships are having to do is pick up that oil in the northern part of the Red Sea, go up to Suez, and if it's a very large crude carrier, one of these sort of 2 million barrel ships, they are then having to unload some of that crude, send it down a pipeline which bypasses the Suez Canal, and then reload in the Mediterranean. Now, and what this is doing is, if you're taking a cargo from the Middle East to China, that's increasing the amount of ton miles, which is the key indicator of shipping demand. It's tripling that. So it's massively increasing the time it takes for those voyages. So as a result, that will absorb an enormous amount of capacity and force the cost of shipping to go up. So these are the sort of issues that we're all talking about. And the full implications of insurance rates for ships transiting the Red Sea. That's really just filtering through now. Several owners were willing to still run the gauntlet of going around the south of the Red Sea and then heading out to east. Over last night, we had a couple of owners who were fixed to do that, and they have chosen to go up through the canal into the Mediterranean and do that much longer voyage. So what we're going to see is an increase in all costs of transporting crude oil across the board. And I'm sure that the protagonists in these various disputes are looking at how demand is going to change. You had reports that the Strategic Petroleum Reserve in the United States, that fell by about 5 million barrels last week. And that's the lowest level that Strategic Petroleum Reserve has been since March 1983. So with the midterms coming up, the price of gas being a sort of defining point in US politics, there is real concern there of countries are now drawing down on the strategic reserves. We don't know where China stands at the moment. I would expect that exports of petroleum products out of China will probably be restricted so they can continue to feed their domestic demand. But overall, right across the board, whether it be the actual transport costs, the insurance costs, all of those costs are going to go up with this latest development in these hostilities.
I mean, it's certainly spiraling out of just a logistical problem rather into a structural problem across economies, as you see it. If U.S. strategic reserves is at an all-time low, and China potentially, as you say, blocking exports of oil, that could have massive ramifications from a broader macroeconomic perspective as well. How do you see that?
Without a doubt. I mean, when we spoke earlier, one of the key things was that it didn't really seem to be affecting demand. I mean, none of you have actually gone to fill your car up with petrol and found that there was none available. Well, now we're going to begin to see an increase in pricing, and then there might be increases in supply. What we are going to see, and I think this is going to be a really interesting development that's going to take over the long term, is that what people have realized is that these choke points, like the Straits of Hormuz and the Red Sea, you need to find solutions to them. And so there may well be, well, let's see what happens with the new UK government, whether they go ahead and start developing North Sea oil again. What you are seeing is that, several American companies last week signed $60 billion of agreements and partnerships with the Iraqi government. And that included plans to restore the Iraq-Syria pipeline, which would provide an export route that bypasses the Straits of Hormuz and the Red Sea. Now, that pipeline has been out of action since 2003 during the Iraq War. Now, if that comes back on, that's an additional capacity of 700,000 barrels a day that can then go out without having to go through these choke points. So everybody is working frantically on finding alternative logistics solutions to getting oil to the export markets that they need to. But, building a pipeline is not the work of a moment.
You briefly mentioned one thing that doesn't get a lot of headlines in the economic press is obviously the human dimension, seafarers and crew, the toll that it has had on seafarers and their families, and obviously as ship owners, and that's probably one of your biggest concerns. How do you see the sort of situation evolve around seafarers who've been stuck for months in many cases?
Fortunately, this is getting a lot more attention now. When this whole conflict started and there were 20,000 seafarers effectively trapped in the Gulf, it wasn't getting that much attention in the mainstream media. It certainly is now, and there have been various developments, and different ship owners take a different approach to it. You had this week, the Indian Director General of Maritime Administration has directed ship owners, managers, and recruiters not to send seafarers from India on vessels passing through the Straits of Hormuz. Now, that's pretty significant if that is enforced, because you've got about 12% of the world's seafarers, in fact, probably more, originate from India. So if they're not able to go there, that's going to have a massive disruption on trade. But, there's always a price on everything. And again, yesterday, the world's largest operator of very, very large crude carriers, which is a South Korean company, they are apparently offering their crews 6 months' salary for a 1-month contract if they go through the Straits of Hormuz. So, you're trying to buy your crew. Now, we all have our sort of views on the morality of all of this, and at the end of the day, it's going down to an individual's decision. But that just shows the full extent of the problem and the stakes involved. If you're willing to give, that sort of pay rise to go through, that does show that everybody recognizes exactly what the risk is. But we mentioned just briefly about not just the Red Sea and the Straits of Hormuz, but also the Black Sea and the ongoing Ukrainian war, that is also having a big impact on shipping. I mean, there's been a really concerted upturn in the drone attacks on shipping in the Black Sea. And since there was a concerted increase in that campaign since about July the 6th, in the Sea of Azov and the Black Sea, so this is all the area around Crimea, there have been 183 attacks on different ships. And now a lot of these are smaller vessels. It's going to have an impact on the global grain trade, this. A lot of this is on smaller vessels, smaller Russian ships trading in those areas, but it has also affected bigger international ships, particularly oil tankers that are loading out of the Caspian Pipeline Consortium terminals, which is where most of the oil exports from Kazakhstan come. 4 million barrel ships, that's 150,000 deadweight tankers, have reportedly been hit in the Black Sea during the course of this week. So there again, the risk there is going up, and that is obviously people now are being much more reticent about going there. And of course, that is going to have an impact on insurance rates.
That's also the grain corridor, as you mentioned.
That's correct.
And, and we haven't, the grain corridor consortium around insurance had fallen. I mean, that's not in place anymore. So that adds to, well, I mean, there's the oil supply risk, and then there's now the, grain and, food supply risk that emanates from this escalation as well, right?
Yes. And of course we've talked about this previously, about the amount of global fertilizer that comes out of the Middle East and the feedstocks for the fertilizer industry. And they've been disrupted. So I think that we're going to be actually seeing the longer term impacts of this, because, your crop yields are going to go down. So this is going to hit everybody in the wallet in terms of food price inflation. We've seen it down in Australia with diesel shortages having an impact on the mining industry there. So the longer term effects, this is not going to be this sort of pledge that it would all be over in a couple of weeks. This is actually going to have some long-term effects that will continue to affect every aspect of the industry. And I think that, we are going to have to, for shipping in particular, if you're willing to trade to those areas, you are going to have to put up with heightened cost of insurance cover for some considerable time to come.
What's your conversations with insurers like? I mean, they're being quick to react to increased rates, tighten to restrictions, terms, exclusions. What is from an insurance buyer's perspective? What are your conversations with insurers like? How do you see, is there capacity in the market? Are insurers reacting? Or how do you see the reaction from the industry generally to these developments?
I mean, it's a good question. We haven't seen any lack of capacity, so you're still able to get the product. And I think that the insurance industry and the shipping industry are being fairly pragmatic about this. And we all realize that, okay, you've got to price that increased risk. And that is what everybody accepts. And in many ways, I think that ship owners there's a degree of sympathy, which you don't get, say, with, if you've got, when the oil price goes up, I mean, that is immediately hit to the consumer. You'll get hit straight away. And when the oil price comes down, passing that reduction in the oil price back to the consumer, that always seems to take rather a long time. With the insurance industry, it seems to be a more pragmatic approach. And for as long as that risk exists, and there are some very smart people evaluating that risk, people are willing to actually pay for it. I mean, nobody wants to go into these hostile areas without the insurance cover, and the market is what it is. And you will hopefully get that increased premium that you're having to pay. You'll get it back from your charterer and your end user, which again goes on to the fact that this is ultimately all going to get passed to the customer, and that's you and me.
Is there anything that you would like for the insurers to do more of, or the industry to act differently in a scenario like this? I mean, in many ways, this is unprecedented sort of risk that we're seeing, and probably the industry is also learning as it goes. But from your conversations, with insurers,
I think the insurance industry, in the current circumstances, is doing a pretty good job with this. What I think is going to happen is that there will be a huge number of new developments over the next few weeks, and it's a moving target. I mean, we could have one of these conversations every day almost. So what we have to be is fleet of foot and be able to react and adjust to what is a very different set of circumstances. I mean, the insurance industry will follow the shipping industry in adjusting to the new dynamics of global supply chains and trade lanes, and we will all just have to adjust to that. And we've seen this before. I mean, the insurance industry has got a great reputation for that flexibility and adaptability. But so long as we can still keep trade moving, I'm sure that you will be able to get insurance cover and the market will absorb it.
If things are the way they are, and we are not seeing any immediate change to the status quo around some of these risks, are we seeing for more permanent changes to how the sort of shipping flow? You mentioned reopening of some of those oil pipelines and things like that, and you mentioned that the choke points, which needs to be workarounds around some of those choke points. Do you see there'll be some permanent changes in how shipping flows in the coming years, or how shippers look to sort of long-term manage their risk and geopolitical and otherwise?
Yeah, I mean, it's geopolitics is sort of right at the top of the agenda now with all ship owners in terms of your investment decisions on everything. I mean, one of the interesting things this year has been that we've had a record-breaking number of new oil tankers ordered. So people actually are pretty confident about the future of the shipping industry and the future of transporting crude oil. And likewise, in the bulk carrier industry, you've got trades changing. I mean, you've got a huge increase in the amount of iron ore that is coming now from West Africa and going to the main market for iron ore, which is China. And yet previously they very much relied on Brazil and Australia for their iron ore. But that is a new market coming that requires new, different types of ships. The changes in the oil market of trying not to be so dependent on the Straits of Hormuz, yes, that I do see. And the developments with the Iraq-Syria pipeline, sourcing new sources of crude oil. I mean, we've got to remember the fact that we've got the entire Russian market has been taken out and sanctions have just been put back on. Yeah, the dynamics of the global supply and demand have been more fluid this year, really, than at any time since the oil crisis of the 70s. So we are all trying to find solutions. And whether some of that, I mean, renewables will make a big difference. I mean, China has done an incredible job on developing its renewables industry. And I certainly see that will probably be expanded further. So new trade lanes will develop. We will, but we're still going to be dependent on the shipping industry. 90% of everything goes by sea. We depend on the ship owners, the ships, and most important of all, the seafarers, to really keep everything going. And I'm sure that the shipping industry, it's always managed to find a solution to these things. One Greek ship owner was saying how Greek ship owners have always been very successful about dealing with blockades, and they've been dealing with that since the Napoleonic Wars, and I don't see any reason why that won't be the case in the future.
Great. I mean, that's that. We've had shipping for centuries, and they've managed all kinds of geopolitical risks. And I don't see why the industry would be any different in this new geopolitical scenario. It's been a fantastic conversation, Tim. I really, really enjoyed it, and your perspectives on the insurance industry. I'm sure quite a lot of our listeners would be very happy to hear your views. Your very views that the insurance industry has been rather pragmatic and supportive. So. Fantastic talking to you, Tim. Thank you very much for your time.
My pleasure.
That's all for this edition of Between the Lines. Thank you for joining us once again. Don't forget to subscribe to our daily and weekly newsletters to keep you informed. Find us at InsuranceAsiaNews.com. My name is Mithun Varkey. Thanks for listening.